Welcome to Harvest Financial Advisors Quarterly Update. I'm Marc Henn, CEO and founder, and this video update is for the quarter ending December 31st, 2025. In this brief update, I'll start with what we saw in the U.S. stock market and the economy over the past quarter, and then spend most of our time on what we see ahead for the markets and the economy in 2026. Over the past quarter, markets moved higher overall, along with a moderate increase in volatility. Economic growth remains strong, and while the labor markets have been under some pressure, they are still generally on solid footing. If you remember, earlier in the year, the market was down over 16%, with the subsequent recovery being attributed to economic growth and the economic ambiguity fading regarding tariffs, allowing investors' fears to subside. Now, as policy uncertainties have faded, we've been able to pay closer attention to what really drives long-term results: company earnings, economic activity, and the health of the consumer. Looking ahead to 2026, we continue to see an economy that, while not without challenges, is on reasonably sound footing. We believe GDP will rise around 2.5% this year, driven by tax cuts and investment. In other words, we see both the broader economy and the real side of the economy, factories, production, and output, continuing to move in a positive direction. A big part of that story is the consumer. Consumer spending has been shockingly resilient in the face of higher everyday inflation, coupled with the resumption of student loan payments. However, with a larger than typical average tax refund expected this season, we could see spending persist in the first half of 2026. And despite calls for AI to take away everyone's jobs, recent reports suggest that weakness in the labor market has less to do with AI and more to do with maintaining corporate profits in the near term. After the uncertainty of 2025, we expect businesses will likely spend more this year. Now, due to the aforementioned economic ambiguity, companies delayed projects and built up their cash reserves. With that ambiguity fading, we see a renewed investment in equipment, technology, and infrastructure. This spending will help contribute to both economic growth and productivity over time. A growing trend we're observing is the continued shift toward economic nationalism. Companies are pledging billions to build manufacturing capacity in the U.S. while reworking supply chains and increasing domestic capabilities. At the forefront of this shift is the technology sector, which accounts for a significant amount of the economic growth we experienced last year. The hope is that these industries will drive labor demand and productivity growth for years to come, while simultaneously ensuring national security ends. While not often mentioned in the media, it should be acknowledged that the median U.S. income is near record highs, especially when adjusted for inflation. Real wages for many workers are at or near historic peaks, particularly for lower earners. Between elevated earned income and a stock market that keeps giving, many consumers are emboldened to continue spending, which is supportive of the economy. Nevertheless, it's important to point out that this picture is not uniform across all households. Lower income households are impacted more by inflation and feel more strain from higher prices in day-to-day necessities. Higher income households, representing the top 10%, now account for more than 50% of all spending. Now for the qualifications. Even though we see growth next year, we also recognize that markets are not cheap. By many measures, markets are expensive and do not always traverse the same course as the economy. Stocks can move ahead of the data, and they can also react sharply to surprises. At the end of the day, an expanding economy, even with some bumps along the way, is still a better environment for long-term investors than a contracting one. What are some of the potential headwinds we are watching? Well, one is the risk that inflation might pick back up or remain more stubborn than expected. If inflation reaccelerates, that could put pressure both on consumers and businesses and could prompt a change in monetary policy from the Federal Reserve. That leads to the second headwind, the possibility that the Fed could shift its stance on interest rates. If the Fed feels it needs to tighten policy again to keep inflation in check, or even signal they are done with cutting interest rates, this could weigh on stock and bond prices. Third, geopolitical tensions remain an ongoing source of uncertainty. These can affect energy prices, supply chains, and investor sentiment, sometimes quite suddenly. Fourth, corporate earnings and profit margins may face pressure if costs rise faster than revenues. Slower earnings growth can be a headwind for stock returns, even in a growing economy. Now, this could lead some companies to have a profitless growth period, where revenue is going higher but costs are rising even faster. Finally, with markets already on the expensive side, valuations leave less margin for error. When markets are priced for a lot of good news, any disappointment, whether economic, political, or geopolitical, can lead to sharper bouts of volatility. In the midst of all this, it's also easy to focus heavily on politics and the headlines of the day. As I mentioned before, there's a tendency to put politics at the center of every economic story. But there are many other factors that are more important to the economy, such as consumer spending, business investment, productivity, and innovation. Elections and policy do matter, but they are just one part of a much bigger picture. So what does all this mean for you as an investor and how we manage portfolios at Harvest Financial Advisors? As a reminder, our role first and foremost is risk mitigation. We know that none of us control the headlines, and we can't predict every twist and turn in the markets. What we can do is build and manage portfolios and plans designed to weather a range of environments. We achieve this in multiple ways, including proper portfolio diversification, along with thoughtful risk management tailored to your goals, time horizon, and need for income. Now, we are very pleased with how our individual stock portfolios have performed throughout this past year, both in the up and down cycle. Our fixed income holdings continue to perform at or above our expectations in this current cycle, and we anticipate a good year for them as well in 2026. If you have any questions, please do not hesitate to contact our office, and as always, we thank you for your trust.